And happy Friday, Market Rebels, and to everybody on our YouTube and Twitter on live stream. It's great having you here. Well, can you believe it? More volatility in the market. What a surprising day. We had probably the big news, if you didn't happen to catch it. Retail sales were down in May, about 0.3%. No surprises there because of the rising prices and the dampened discretionary demand. They were expecting a bump in June of plus 0.9%, and it came in at 1.0. Now, that's not necessarily a big jump, but it's the fact that it wasn't worse. And I think that's really what the market is looking for, any signs that things are actually getting worse. So because of that, the futures popped about 300 or 400 points in the Dow. Been looking strong. We were about 1.8% or so, I think, on the SPY going into the close here. So who would have guessed? But anyway, it brings up more points about trading and strategies and your choices that you make. And that's what we're here to talk about in Trading Tune-Up. So for those of you who are new, we do this every Monday, Thursday, Friday, 4 p.m. Eastern Time. And what I wanted to do was to start a little bit of a new series here for next week and a half or so. We want to talk about vertical spreads, various aspects of them, and how you can use them for better strategic decisions. But for today, I wanted to attack one of my most favorite topics where people make the most mistakes, and that is with credit spreads, or at least when to use them or when not to use them. So we're going to look at the topic here, credits are debits. Now, I know you're probably thinking, how is that possible? Well, it's absolutely true. If you do a credit spread, you are doing a debit spread. And we could also say if you're doing a debit spread, synthetically, you're doing a credit spread. That'll make a lot more sense in a minute. But the main point that I want you to get from this, I'm going to tell you up front and at the end as well, to make sure everybody understands it. Do not do a credit spread just because of the word credit. You're not getting paid to do anything. And then next week, what we're going to do is to look at 3 different reasons that would make sense from a strategic standpoint of why you might use a debit or a credit from a professional trading standpoint. So that's what we're going to do. So for today, let's start off with a quick definition of vertical spreads, very popular strategy during times of high volatility. You are going to purchase one strike, sell another of the same type meaning they're either both calls or both puts. They have to have the same expiration, at least to be a vertical spread. So for example, if you buy the July 100 call and sell the July 105, that would be a vertical spread. You could also buy the July 100 put and maybe sell the July 105 put. Now, they're called vertical spreads because if you look at the way they're laid out on your broker's platform, you'd be operating in that vertical column. You'd be in the same expiration date at the top, and you're just spreading off different rows or different strikes. So those are different vertical spreads. Now, within vertical spreads, we have 2 basic camps. We have bull spreads, and you can create a bull spread from using debits, which would be with calls. We could buy the call spread. You can also do it with a credit spread. With puts, you would sell the put spread, and that would also put you to the bullish side, have a bullish bias. We can also do bearish outlooks or bearish leans. If we do a debit spread, we would be using puts. You would buy the put spread, and that's going to have a bearish bias, or you could sell the call spread and get a credit and be bearish. So notice there are 4 basic ways of setting up a vertical spread: debit, credit, bull, and bear. Now, the problem is for most traders, they hear the word credit and they think, well, this is an easy decision. Who wants to do a debit when you can get paid? Right? That's what sets up the problems. So, of course, if you walk into a bank and the teller says, would you like me to debit or credit your account? Just take my word for it. The answer is credit. That is no question that is the better choice, all things being equal. And unfortunately, that's how traders see the vertical spreads. They say, well, gee, if I have to either pay for it or if somebody's going to pay me for it, might as well get paid. Or they'll say, I'm trying to generate income. And you're going to find out both of those are false. You're not generating income. Or my account's down so much, or I took a big hit so far, let me sell some spreads so I can get some cash into my account. Again, false. Those are never, ever the reasons that we do the choose between a debit or a credit. Now, again, to find out the details, that's what we're going to do next week, Monday, Thursday, and Friday. We're going to look at a different method each day. So for right now, realize this is where most people make their mistake. They assume that they are getting paid for it. So let's break it down and find out why that's not true. Let's start with the bull spread with calls. It's a debit spread. You have to buy it. So let's say that you buy the 100 call and sell the 105. Now, this would be, let's say, for example, for a net debit of 2. Now, based on what we've talked about up to this point, we've done 2 pricing principles. What was the first one from last Friday? Lower strike calls and higher strike puts have to be more expensive. All right, and this is a debit because you are buying the lower strike call. That's the only reason it's called a debit spread. The price difference between those 2 strikes is absolutely going to be a debit. Now, when you do this, you have the right to buy shares for 100, and you've got the potential obligation to sell for 105. What's the most that spread could ever be worth? That was pricing principle number 2 that we looked at on Monday. What was that? $5 potential gain. That's the most it could ever be worth. Not what it's going to be worth, it's the most it could be worth, the difference in strikes. So the thing to understand is that you are buying this, that you are paying money for this. And so sometimes you'll hear me tell traders to think of it as an asset, right? If you buy a bond, if you buy a stock, you buy a mutual fund, you buy a house, a car, a computer, those are all assets. They have productive capacities. And that's what's happening here. So despite the negative connotation that some people think with the word debit, there's a reason it's a debit. It might produce more value. So this is our risk graph. This would be buying the 100 call and selling the 105. As always, we could get our bends at these strikes. And if we paid $2 for it, the most the spread could ever be worth is 5. So what lands in our pocket? The net would be 3. And that's because we're buying the low strike and selling the high strike. And again, the most it could be worth is 5, so the most this spread could ever be worth by itself, meaning you look on your broker's platform, it says going into expiration, stocks above 105, it's trading for 5. So if you sell it and you put 5 in your pocket, but you spent 2, the net to you is 3. Okay, so that's a bull spread. Now, what about the bull spread with puts? We can get the identical risk graph by using puts. I know it sounds odd because most people associate puts with bearish, but we're selling it. So this is going to be a credit spread. So let's say that we buy the 100 put and we sell the 105. And let's say it's a net credit of 3. So again, this is what grabs everybody's attention. They go, ooh, I get paid for it, much better. Well, not necessarily. It's a credit spread because you are selling the higher strike put, right back to principle number 1. Notice that you are buying the 100, selling the 105. So if you're selling the more valuable asset, obviously on a net basis, you're going to have cash in your pocket. However, take a look at the rights and obligations. You have the right to sell the shares for 100 with the long put, but you've got the potential obligation to buy for 105. That's what happens when you sell a put. It's a potential obligation. So now think about it. If you buy the shares for 105 and you sell them for 100, what is that? Not doing too good. That's a $5 potential loss. So try to divide that up any way you can. Buy the 100 put, sell the 105, and see if you can make it become an asset. It is nothing but a liability. Now, as I always point out, that does not make it bad. It just means that you have to get your perspective right. It's a liability spread. That is why you are getting paid for it. Nobody's going to say you have to pay me to accept a liability. Okay, so that's what's happening is that you are getting paid. Think of it like an insurance company. You pay a relatively small fee, let's say for an auto insurance policy, and the insurance company is on the hook for potentially a much bigger loss. And that's what's happening here. You're going to receive something less than 5, or whatever the difference is in strikes, but you now have an obligation equal to the difference in strikes. So it's a liability. And again, that doesn't make it bad. It just means you have to understand this to figure out which is going to be best for you at whichever times you happen to be trading. So now take a look at this. It looks exactly like the risk graph that we saw. Absolutely identical. The difference is we're starting up here with a $3 credit, but we have the potential to lose 5. All right, so again, you're buying the low strike put, selling the high strike. That's a $5 obligation. So once again, this is where the traders get tripped up. They think, oh, I'm getting paid for an asset where I can make even another $5 or whatever. Not true. It's a liability. And that's why you're getting paid. All right, so if we looked at the long put spread, if you bought the 105 and sold the 100, it would be bearish. This would be the risk graph. So notice that you're just the trader on the other side. That's what's making it a credit, and that's what's making it bullish. Everything is opposite. The bear buyer, this guy right here, would have to pay 3, potentially earn 2. You're receiving 3 and potentially losing 2. So they're just two different ways of going about the same thing. So one little mnemonic that I teach traders is buy low, sell high. And if you look at those initials right there, it looks like the word bullish. All right, so for any spread, whether it's a call or put, if you buy the low strike and sell the high, it will have a bullish bias. Obviously, if you buy high and sell low, it's going to be bearish. So if you buy the 100 call, sell the 105, buying low, selling high, it's a bull spread. In this case, it's a debit because it's calls. But if we buy the 100 put and sell the 105, you're still buying the low strike, selling the high, but it's a credit. But they're exactly the same thing because one is an asset and one is a liability. So think about this. With the debit spread, you can pay 2 to possibly make 5. And with the credit spread, you can receive 3 to possibly lose 5. So think about it. It's a little puzzle. They're just two different ways of saying that your maximum loss and your max gain is 3. They are absolutely identical. Now, again, this is in the absence of any market skews. That's one of the things we'll talk about next week, which might make us lean towards the debit or a credit. But in a pricing model world, in a perfect world, they're going to be absolutely identical. Now, again, what happens, people think that, oh, I'm receiving 3 to possibly make 5. That's the mistake. And if that were true, there would be no reason to even entertain the idea of a debit spread. That would be an arbitrage. Okay, so remember that. It's too good to be true. You have to receive money if you are willing to lose more. And that's what makes it a credit spread. So let's break it down a little bit more. If we have a debit spread on the left for $2 with the calls, we could lose 2 and make 3. But over on the credit spread, we're going to receive 3. So notice a relationship. The max loss plus the max gain on the credit spread equal the difference in strikes. Over on the left, if we paid 2, we can make 3. On the right, if we receive 3, we can lose 2. Notice they're absolutely identical. If we had paid 4 over on the left, this would be a credit of 1. If we paid $1.50 over here, this would be $3.50 would be the credit. They're just two different ways of doing the same thing. So now think about this. Here's a bell curve. Again, some people say, oh, I like paying 2 and possibly making 3. That sounds like a good risk-reward ratio. And conversely, they might say, oh, I don't like doing the credit spread in this case for 3 because I might actually lose 5. But the reason for those prices is it depends on the probabilities. So in this case, we've got a little bit of room to go to get to this maximum gain, which means the stock is far more likely to be down here. All right, and that's why we're going to have to pay more to potentially, pay less to make more, and therefore we could receive more and possibly lose 5. It all comes out in the wash based on probabilities. So this is now another thing to look at. This is the amount of the expected gain from a pricing model. If an option costs 2, that's the amount you're expected to lose. Kind of weird, isn't it? But the expected value is 0, break even. If you receive 3, this is the amount you're expected to lose. So another reason to show that it's not about saying, ooh, give me credits, they're better. You're just getting compensated for the expected loss. Okay, so finally, let's take a look at this. We have our debit spread for 2. What's the broker going to do for you? Going to debit your account $2 because that's the maximum loss. What if you opt for the all-powerful credit spread for 3? And remember, if the debit spread is 2, the credit spread, the corresponding credit spread, would be selling for a credit of 3, and therefore have a max loss of 2. Well, the broker is going to say, okay, take a look at this risk-reward graph. Yes, you got a credit of 3, but I couldn't care less about what your maximum gains are as the broker. I understand that you could lose 5, So I'm going to hit you with a $5 margin requirement or $500 per spread. And on a net basis, because you also collected 3 in your money market, it's going to be a net debit of $2. And notice that they are absolutely identical. And this is why debits are credits, credits are debits. You can do all the credit spreads in the world. In the end, once you get the trade executed, it is a debit. So if you're trying to generate cash, not happening because you're spending money. You're getting debited every time you put these trades in. So again, that doesn't make it bad. A credit spread is not bad. It's a tool. But what we're going to find out next week is why we might choose a credit spread in some situations and why we might choose to do the debit spread. Okay, so hang tight for that, and please join us for Monday, Thursday, Friday at 4 p.m. Eastern next week for those answers. In the meantime, just remember the mantra for today. Don't use credit spreads just because of the word credit. And again, that raises the big question, well, then why should we choose a debit spread or a credit spread? So I want you to think about that over the weekend. What would be some reasons for choosing one of these over the other? And we'll give you the answers next week. But in the meantime, if you don't know the answers, or even if this entire presentation was new to you, this is really good proof that you can benefit from coaching. Everybody can. We are inviting you to have a free 30-minute one-on-one coaching session with one of our really world-class coaches. A lot of them have decades of floor trading experience, market making experience. There's not an options question that these guys can't answer. It's free. Check them out. Say, here's what I'm trying to do. Here's the type of strategies I do. And watch the doors that they open, things you never, ever thought of. And if that's true, then you have to say, why wouldn't you do it? Because you're going to be the beneficiary. And again, this is absolutely free. So the phone call is 815-957-9125. That's the number right there on your screen. Please give them a call. Check them out. Just say, I got this from Trading Tune-Up, and I just want to check out, I do vertical spreads, or I do covered calls. What are some things you can tell me? And you'd be amazed at the things that you don't know. Okay, so that's what we're asking everybody to do. Please give them a call. And in the meantime, I want to wish everybody a fabulous upcoming weekend. Look forward to probably more volatility next week, and then we'll give you the answers next week, Monday, Thursday, Friday, why you would choose a debit spread or a credit spread. And we'll see you then.